So Pierre, for the earnings results, I just wanted to ask about the downstream. It seemed like you took a loss on the downstream in the fourth quarter versus the third. What went on there?
Well, market conditions continue to still be challenged in the downstream. I mean, we're not operating back at a full economic recovery. So we continue to operate very safely and reliably, and we're serving our customers, but demand is down a little bit. We also had a couple of one-time items and inventory adjustment, which contributed to the loss in the fourth quarter.
So if we're able to kind of look maybe at the downstream as a proxy for reopening and sort of people moving and health of the economy, I mean, have we bottomed? What does Q1 look like in your visibility?
Yeah, no, we certainly bottomed. I think we bottomed in the second quarter, which was, famously when oil prices went negative. We've seen a recovery since then, but we're at a plateau that's still below pre-pandemic levels. So for the downstream, I mean, demand for our products is only down about 5% relative to where it would have been pre-virus. But for the downstream, that's the price setting 5%. So we'll need to see, vaccines come in, return to a lot of the discretionary activity we're not doing, international travel, office workers going back to the office, seeing their colleagues, grandparents seeing their grandchildren, all that we hope when we see vaccines fully deployed. That's when we'll see a full recovery in the downstream. But we're seeing oil prices, of course, in the upstream quite a bit higher. So we'll see a recovery in the upstream that's going to happen a little bit before the downstream.
So when do you see all that normalizing?
Well, no one really knows, right? We're still in a difficult time here. There's reason for optimism because we know vaccines are being deployed, and we know they'll have a beneficial effect. So we really do need to get control over the pandemic so that everyone can get back to work and we can get back on a pathway to a full economic recovery. So, your guess is as good as mine, but it seems like second half of the year is a good time where we could be something that looks more like normal.
Yeah, I know I'm not a betting person. So with that, do you expect this is the obligatory oil question. Do you expect prices to then stay in a 50-60 range? Like what do you think normal is now for oil prices?
Well, predicting oil prices is a difficult thing to do. As oil prices are $55 right now. We feel like they're probably a little bit ahead of the fundamentals because we're still, again, seeing economic activity, constrained by the virus. But an oil price in this environment, is in 50 to 60 is a reasonable oil price. That said, we're not counting on it. We're focused on capital discipline, cost management. We're focused on what we can control. Our cash flow break even to cover both capital and dividend is less than $50 Brent, even with weak downstream margins. So we've taken a lot of actions to show our shareholders that our dividend is sustainable and we can grow it even if oil prices stay below the range you were talking about.
So if we just get into that a bit, for the whole year, and correct me if I'm wrong, your cash flow from operations was about $10.6 billion, but your CapEx was 13.5, and that's not counting your dividend. I mean, that doesn't feel like you're stockpiling cash. It feels like you're burning some.
Yeah, no doubt in 2020, we were negative cash flow. The cash flow from ops number, you have to adjust for working capital, which is a timing that goes in and out. That capital number, not all of that is cash from ops. So is cash that's wholly owned. So some of it's with our affiliates. It does not require our cash. But you're right. We did not fully cover our capital and our dividend last year because oil prices were at $42 on average. So the last 2 quarters, our cash flow break even has been under 50, which means, again, we can cover our capital program and our dividend going forward at under 50. And right now, oil prices are $55 versus the $42 that we saw last year.
How much of the cash that you're making are you going to reinvest? I know it's hard to do for larger companies, but like E&Ps are looking at 80%, for example.
Yeah, well, we're not an E&P. We're a global company. We have a downstream business and a chemicals business, and we have a track record of delivering cash flow to our shareholders, unlike many in our sector, right? We've increased our dividend 33 straight years. We increased our dividend 8% last year. We've also bought back shares 13 out of the last 17 years. So we have a track record of generating excess cash and not over-investing. There have been too many companies in our sector who've been trying to grow too fast and haven't generated the cash and the returns for investors, and that's part of the reason why the sector is out of favor with investors. But I don't think we've been one of those companies. We've been very good at generating excess cash and rewarding our shareholders with a steadily growing dividend. And when we have excess cash, for example, if oil prices are higher than $50 or $60, we have the ability to buy back shares.
What else are you going to do with your cash? What's your appetite right now for more M&A?
Well, first, we're proud that we were the first to announce and close the transaction, right? We announced the Renewable Energy acquisition in July. We really showed the way for the industry on how to do it on an equity basis and with a low premium. We closed it very quickly. We've been operating here for several months. We're really happy with the assets that we acquired, with the people who have joined our company, and it's accretive to all of our financial metrics. So we feel really good about that. I do think you'll see more consolidation in the industry. Whether we participate in that, I won't speculate about that. We certainly don't have to do an acquisition. We have a great portfolio and we're very well positioned. We have a very high bar, but if we see something that we think is in the interest of our shareholders, of course, that's something that we may choose to do.
Do you feel like the opportunity is past with the oil prices having recovered and now moving higher and sort of re-rating in a higher base?
I don't think so. Again, I think for the industry, I think we're likely to see consolidation. You know, the industry is still challenged to attract investors. There's too many companies trying to grow too fast and with too weak of balance sheets in a business that we know has cycles and where the commodity price can be volatile. So I expect you'll see continued consolidation, continued financial strengthening, trying to get companies that have stronger balance sheets so they're better positioned to generate free cash flow and return cash to shareholders, which is what they expect.
With the other part of your cash flow, at what point do you think you return to the aggressive growth targets that you had in the Permian that you had to kind of put aside because of the pandemic?
Yeah, so you're right. We have paused in the Permian because the world doesn't need more barrels, and we didn't want to spend more capital to add barrels into an oversupplied market. But the resource is there and the opportunity is there when the conditions are right, and we expect those conditions. We don't know exactly when they will be, but those conditions will come to us in the future. So our growth rate in the Permian was an outcome of a very disciplined investment program, and it's offsetting other parts of the company. So we're a big company. We're not a pure play E&P. We're not a pure Permian company, but we have a very attractive Permian position. We have this advantage royalty position. We're as efficient as anybody as we are there. And so when the conditions are right, you would expect us to go back and increase investment, and we can get back onto a trajectory like we were before.
Help me understand what those conditions look like.
Yeah, it's very simple. I mean, we need to get control over the pandemic and be on a pathway to a sustained economic recovery. We need to see inventory levels get back to a more normal range. And then we want to have an idea of what OPEC Plus is going to do. They have a lot of barrels, obviously curtailed right now. So when those conditions are right, and we could see that here again, maybe second half of the year or early next year, that'll be appropriate time for us to potentially go bring investment back to the Permian and other locations.
And if you do bring it back to the Permian, do you expect it to be with the same kind of aggressiveness that you guys were targeting before, or has the mentality around how to allocate kind of shifted with the pandemic?
So again, we never felt we were doing aggressive growth. We felt we were doing a very disciplined investment program. And look, we're going to continue to be disciplined with our capital. And so it'll be a steady buildup. It'll be an appropriate pace, and the production will be an outcome of those investment decisions. We're really focused on two things: higher returns and lower carbon. We have to generate higher returns to attract investors to the sector, and we need to do it in a lower carbon way over time. The Permian contributes to both of that. It can generate high returns, and it's a low carbon intensity barrel. So it's a good place for us to invest, but we're not in a rush. We're not trying to outgrow. We are trying to deliver higher returns and lower carbon over time.
What about LNG? I mean, the prices over the last 8-9 months have been really insane, quite high, move with a lot of volatility. And I wonder if the pivot, will there be a pivot for Chevron at all in developing gas developments in the Eastern Mediterranean, for example, or putting a little bit more weight in the LNG world?
Well, we're big in the LNG business, and as you say, Eastern Med is a great position that we got through our Renewable Energy acquisition. As you know, most of LNG is contracted under long-term contracts, which we still like. The spot market is relatively thinly traded, and as you say, we saw prices as low as $2 here, earlier last year, and spiking. Some reports of individual cargoes at $20 or $30 happening right now. It's a fairly modest number of cargoes. The vast majority of liquefied natural gas is traded under long-term contracts, and that's a business that we really like. We have a big position, but again, to make investments going forward, we'll have to attract a higher return and be very disciplined in the projects that we choose. Again, we're focused on capital discipline, cost management, having investments that really earn a good return through the cycle.
Before we move too far from the U.S., how are the changes in U.S. policy going to impact that capital allocation?
Well, I think it's a little too early to tell, really. We support the Biden administration's priorities to get control of the pandemic, to get the economy on a full recovery path. We support the Paris Accords, and we are aligned with the U.S. rejoining the Paris agreements. We don't think it's good policy to be overly restrictive on federal lands. That'll just move energy production to other countries. We know that we can develop energy in this country responsibly. We know that the jobs are really important, in particular when we're trying to recover from a pandemic. We also know that the taxes and royalties that we pay to state governments, to states like Louisiana and New Mexico, are going to be very important as the states, again, recover from the pandemic. So we look forward to engaging with the Biden administration and really making the case for why we can both produce energy in this country and address climate change.
When you factor that into things like then maybe bigger caps on methane emissions, more disclosures on an ESG kind of level, different tax implications, et cetera, does it make you look at different regions than the U.S.?
Well, we are a global company, and we're upstream, downstream in chemicals. So we can invest in lots of different places. We like investing in the United States. We have a big investment program in the United States, and there's attractive opportunities here. And again, we believe it's good for the country to be producing energy in this country versus importing it from other countries. Look, we look to the future, and we are committed to advancing a lower carbon future. But we also need to look out the window. And the reality is right now in the United States, there's 270 million registered vehicles. 269 million of them rely on internal combustion engines. So we need to deliver the fuels of today, tomorrow, for the next decade, and well into the future. And we intend to do that.
Then putting you aside for a second, for the industry, do you think that all of this is going to raise the cost of capital too much? Like, what's going to be the impact there?
Well, look, I think the market has acted well before the administration, right? The energy sector has gone from over 10% of the S&P 500 to down to a little bit over 2%. So our cost of capital has increased. I don't think it's primarily due to climate change or ESG. I think it's primarily because we haven't earned our cost of capital. And so why you hear Mike Wirth, our CEO, talk so much about capital discipline and how we conducted ourselves with Anadarko and walking away from that acquisition with $1 billion. The timing that we did with Renewable Energy, doing it in July, the first one to do it, how we took our capital program down 35% from where it was previously, and how we've given guidance for very tight capital going forward. The way to increase returns is not by investing more capital, it's by being more disciplined with our capital. So that's really our primary focus.
Okay, great. And then going to a different area here, Bloomberg News broke a story that you guys have been in talks with the Biden administration about Venezuela. And I wonder, do you have the feeling that there may be some thawing in the new administration towards Venezuela?
I really won't speculate about that. You know, we've been in Venezuela a long time. We're committed to our employees on the ground. We want to work with the U.S. government on what's the best policy. We did write off our Venezuela investment last year, so it's something that we're focused on, just supporting our people on the ground, and we'll be aligned with the U.S. government as it goes forward.
As a CFO, though, do you still expect to be there in a year's time?
I'm not going to speculate about what happens. We've been in Venezuela a long time. In most countries where we operate, we're over there in decades, and there's ups and downs in all the countries where we work, and there's change in administration. So, we work well with politicians and governments of both sides in this country and other countries. We have to, if we're going to stay in a country for decades or 50 years or 100 years. That's how we think about it.
My last question for you has to do more with the ESG. You guys have done a lot this year in terms of renewables and biofuels, et cetera. And I just want to get your take on what's the one thing that you're most jazzed about for this year when it comes to the work that you're doing greening energy?
Well, the one thing would be renewable natural gas. We started up a renewable natural gas project in California. We expect to start up last year. We expect to start up another one here this year. It's really a way that you capture methane that otherwise would be vented to the atmosphere from dairy farms. We process it, we put it into the gas grid, and then we contract with trucking companies. And so it becomes a very low carbon fuel. So that would be one thing. But we're working on hydrogen. We're working on carbon capture. We're working on abating carbon in our own operations. We're going to process biofeed at our refinery in Los Angeles later this year. So we're trying to do a lot to advance a lower carbon future.
How fast do you think everything scales?
Not as fast as people would like. I mean, look, the reality is it does take time to work on these things. You need to get permits, you need to construct them, but we're working fast. And look, we expect to see more over time. But it's a little bit what I said earlier. The market's great at looking to the future, but the market also has to look out the window. It's a false choice to think it's one or the other. Our products are going to coexist with a lot of other renewable products over time. We've seen that in California, which has had greenhouse gas regulations and carbon regulations for more than a decade. And that's how we have to think about it going forward.